Good afternoon, ladies and gentlemen. I'm sorry you have to see my face again. Well, I'm going to take you through our journey in agri supply chain. I call it supply chain, and finance comes later. It's a journey, nevertheless. Like they say, it's the going and not the getting there. And we take it one step at a time. We come from an organizational background which lays a lot of stress on viability, that means doing business profitably, and a lot of stress on cross-sell. So put these two together, and that gives us the philosophy behind the whole approach. I'll run you through just briefly on what we did in Kampala and where we are now. So the missing middle. So the missing middle, that's what we are targeting here. If you look at India, large agro producer, 60% of the population engaged in agriculture, very low on exports, very high domestic consumption, very low productivity levels. Average farm sizes of about 2 to 5 acres. And that is the missing middle, or the single largest, or the neglected farming community, so as to say from a financial point of view. Common problem that we all face is high cash intensity of these transactions, these markets that significantly increase our operating costs. With that background, a little background on agricultural lending in India. Banks are mandated by the regulator to do agricultural lending, of which 13.5% of your advances need to be in farm credit, that is direct loans to farmers for production, or to poultry, or for dairy or milk, but direct agricultural production, and another 4.5% to support functions in agriculture, which includes retailing of inputs, warehouses, and things like that, excludes processing. So agro-processing is not included in this. Now, this mandated regulation is a double-edged sword, so as to say. So a lot of banks do it because they have to do it and don't necessarily follow a profitable or look for profitability out of the model. That is one aspect of it. And because they have to do it, it is all, again, collateral-based lending. So they look at collateral and lend, not necessarily looking at a proper assessment. And that is further fueled by rapidly increasing real estate prices, farmland included. There's a reason for that. Maybe we'll dwell on that a little later. The good thing, though, is we have a relaxed asset classification norm, as we discussed a little earlier in the morning. We get 2 additional crop cycles after the due date before we have to start providing for that loan or classify that customer as a delinquent customer, which means after 365 days of the due date is when an account becomes a non-performing asset. So keeping in line with other businesses that get 2 or 3 cash flows before they become non-performing, agriculture also gets at least 2 crop cycles before they become non-performing. I think this is a very important point that really facilitates banks to be in this business. So far, agricultural lending has been dominated by government banks and cooperatives. There's also a host of interest rate subsidies that these banks do enjoy, and that kind of distorts the playing field for private sector banks like us. So we have to find our own niche markets, find people that are willing to borrow. Here again, like we heard in the Mahindra presentation, it is cost versus speed. So if we can process faster, we can charge a little, what may appear to them as a premium, but a normal rate as a normal market rate for us. On the distribution side, this is distribution may not be the right word, concentration. most of the farm lending is based in the green revolution states of North India. That is the mirror image of what Kashif displayed in Pakistan. We have 5 rivers flowing into the Indus in Punjab, and we have the Indo-Gangetic Plain. And that's where India followed the green revolution, and for banks, that is the safest possible business that you could do in agriculture. There's no performance risk because there's plenty of water, simple 2 crop cycles, large farmers, and no price risk because the government is the largest buyer, and there is a support price provided by the government which keeps on increasing every year. So 0 risk as far as these 2 states are concerned. And so it was with us that we also started out our business out of these 2 states. Further down south, the trend is largely to lend against jewelry. So here again, it all becomes a collateral kind of lending and not necessarily an assessment-based credit, or not even monitoring whether the credit is actually resulting in an increase in benefit or wealth to the customer. The large central parts have been, by and large, dominated by the cooperatives who have not been in the best of health. And just to give you the scope of the market, in India, there are 600,000 villages, and banking has only reached 40,000 of them so far. So irrespective of subsidies, irrespective of reach, there's enough of a market available for someone who wants to get it. Markets are kind of distorted with the government being a large buyer of wheat and rice. The other produce go through local state-run markets, which had a purpose some time back, years ago, where it served as a medium to regulate traders. But I think its sell-by date is gone, and now this is getting done away with, which means that private companies wanting to purchase direct from farmers need not go to the state markets to buy commodities, which means it will give legitimacy to contract farming, which up till now was a problem in most states, where anyone, even if you wanted to do contract farming, you still had to route it through the state-run markets and pay a little tax. So that's kind of been done away with most states. Some states still have that problem, but it's going off. So that's a positive. Cash is still a big problem. It's come back here again. And it's important to know that most farmers are not dependent on a single crop. They diversify themselves to do multiple crops. So they'll do cereals. They'll have one main crop, anchor crop, but they'll also do a little bit of vegetables, and they'll also do a little bit of dairy to keep the family fires burning, and also to hedge their risks. So they pretty much hedge themselves, free themselves, running their own little show, irrespective of all the constraints and lack of finance and stuff like that. But that does not really help matters because they still remain highly unproductive. At HDFC Bank, we are relatively new to this business compared to the other banks in India who are a good 70, 80, 100 years old. We are a 17-year-old bank and about 7 years in the agriculture business. We started off both on the post-harvest credit and pre-harvest credit around the same time. We had a share of troubles, and we've come out pretty well after that. Post-harvest, we started with warehouse receipt, which in India was highly dependent on collateral managers, and which resulted in a higher operating cost, which in turn resulted in a large ticket size. But the industry did get hit by a lot of irregularities in terms of missing stocks, bad quality stocks, stocks not matching the warehouse receipt, what was certified on the warehouse receipt. So those were the kind of problems we had on working on warehouse receipt. So along with that, we started doing cross-sell, and we started looking at working capital for the same set of customers. Warehouse receipt is mainly post-harvest, so traders, agro-processors come in this category. Retail lending to farmers is, again, standalone credit to farmers. Here, like I mentioned, we started in the northern states, the Green Revolution states, predominantly large farmers, 5-acre plus, 10-acre plus. If you take the 10-acre benchmark in the Green Revolution states in the north of India, which is Punjab and Haryana, 7% of the farmers are large on this benchmark of 10 acres. If you take the other 4 progressive states, which is Rajasthan, Madhya Pradesh, Gujarat, and Andhra Pradesh, and Maharashtra, 5, the number of large farmers with 10-acre plus holding drops to 2%. And the remaining states of India, the land holding is, the number of large farmers is less than 1%. So that's a huge, huge challenge for us. So that's something that we learned the hard way when we started expanding our business outside Punjab and Haryana. That's what we realized, and we ended up spending far too much money searching out for these 10-acre farmers, going in all directions. And more often than not, they were out of the coverage area of a branch. Coverage area, self-defined by us, it was basically 1 to 2 hours travel time. If it's beyond that, then you're not going to have a relationship manager monitor that loan effectively. So 50 kilometers or 1.5 hours travel time. So we were missing out, clearly. But having said that, our farmer loan, which is of much smaller ticket size, has far exceeded our post-harvest loans, which are bigger in size. And that's the trend that we see. So we see a bigger portfolio on pre-harvest than post-harvest. So when we moved out of the big Green Revolution states, faced with this challenge of limited number of large farmers, we had to find a way to increase the density of smaller farmers and reduce the cost of operations. The cost of operations come from 2 parts, like I mentioned in the first session yesterday, is the cost of acquisition and the cost of servicing. The cost of acquisition generally gets written off for a large loan. It gets written off over maybe 3 years. For a smaller loan, it takes longer when you do it on a standalone basis. But an amount equivalent to 50% of the cost of acquisition is what you incur every year. Because every season, every harvest, you have to go to the farmer and collect cash to service that loan. Get him to service that loan or collect cash. And this is really where the difference comes between a commercial loan, a commercial retail loan, and an agricultural loan. In any other type of loan, be it an automobile loan, a tractor loan to a commercial user, a vehicle loan, credit card, you have the interest or the amount servicing directly debited to a checking account, a savings account. But that doesn't happen in agriculture. You've got to collect 100%. In all other products, you only need to collect the delinquent amount, which may be 5%, 7%. So that's a huge, huge cost. And when you look at a farm size of 3 acres, you're going to break even in the 5th year. On a large farm, you could probably break even in a year and a half. So we looked at this primarily from a cost perspective. We said we look at existing supply chains that work and improve their efficiency. So we looked at sugarcane, dairy, and seeds. These were, at that point in time, and still are, the tight value chains that are available in India. And we looked at, the route that we looked at was not lending. We looked at a payment solution approach. So we started with payments because that was our USP for reducing our cash. The payment solution, how did we improve the existing ones? We looked at faster payments for the farmers, so build efficiency into the transaction process. Transaction transparency, I think this is a key element in developing markets. That means if someone's receiving a payment, somebody may be getting a cut out of it. You never know. So we brought in transaction transparency. We brought services closer to the farmer's home and easy access to loan products. Farmers are not used to approaching a bank directly for a loan product in India. They generally have to go through agents, touts, pay a cut. So that So that is something that is the kind of efficiency we brought into this process, the intervention that we did in existing supply chains. Quickly to just compare, and this is the concept that we discussed in Kampala, and then I'll go on to what were the experiences. On the acquisition process, in open market, we reach out around our branches, and we have walk-ins into the branch. Whereas in supply chain, we go where the supply chains are based, and we use business correspondents. On the distribution side, in branch-based, we work around branch geographies. In supply chain, we are not restricted to geography. Here, there is another challenge that comes up. If you have a branch there, the local governments expect you to do a certain amount of agricultural lending, irrespective of your regulated targets by the central bank. So that does create some problems, but we then can make up with these kind of things. In open market, we start with the asset first. We do the lending first, and then we look to build liabilities, which is a challenge. But in 10-acre plus farmers, we still can get some liabilities. In the supply chain, we start with the liability account and then build up on the assets. So it's more of a cross-sell, just like, and what we modeled it on the basic salary account that we use for corporates. We do the salary account, and then we load on consumer loans, credit cards to that. We use the same principle here. And the net impact is productivity. Under open market, an RM can do 4 loans in a month. Under supply chain, in the initial period, we are able to do 10 per month. So a straightaway jump, straightaway increase in density creates this kind of mechanics. And by virtue of that, our cost of acquisition per loan, which was 25,000 rupees, drops to 11,000 rupees per ticket. Similarly, the cost of servicing a loan now, from an average of 5,500 rupees per harvest cycle, is nil, because the money is flowing into the bank account. So there's a huge advantage, a huge cost benefit that we derive by going this route. And this is articulated here on a 3-acre farm loan, where we can, on an open market, 3-acre farm loan on open market would break even in year 4. A 3-acre loan under supply chain breaks even in year 2. So how did we go about it? And what were our learnings so far? So to begin with, response from corporates and buying organizations. The challenge was to identify committed corporates as the anchor companies, and this was a very big challenge because a lot of companies were not true to their word, and somewhere in today's presentation also it came out that the banks were left to do all the dirty work. In year 1, corporates were absolutely not keen, but some of them thought they were being good to us and said, okay, go ahead. In year 2, things started to change a bit, and year 3, which is 2013, we can actually feel the new age of agriculture coming upon us. Like was mentioned in the keynote address, we are seeing a lot of attention now being diverted to sustainability and security of resources, raw materials. So that's a good thing, and things have started really looking up for us. For instance, one of the names that was discussed in the keynote address, it took us 18 months of discussion before we could open the first account, first farmer account. And it had to come, eventually the decision for that company was taken at the head office overseas and not the India organization. So obviously there is a big benefit that supply chain will get from this new age of agriculture. From the farmer side, we were a private bank. We didn't have access to subsidies. We're not a good name to reckon with as far as the locals are concerned. So there's extensive use. Basically, the BCs were used to get them closer to us, and that really kicked off a good kind of a feeling with them. We moved from pilot to scale in October, and we moved from 70,000 farmers to 350,000 farmers under the supply chain very quickly. However, account activation, how many accounts did get money into their account? As we stand today, out of the 350,000 accounts, only 100,000 did get money in the first season. Some of it because companies didn't pay through us. The others were because we missed the payment cycle. Pardon me. Sorry. So some of them, the initial approach was to do some unsecured loans, which were under company program, micro-irrigation loans, various other type of loans that the companies were interested in us doing without security. We touched about $25 million worth of these loans. But the other part, which is working capital, proper agricultural loan, which we cross-sold to these farmers, was $250 million. So very quickly, we moved that number up. So this was a sugar mill, a cooperative sugar mill that we did in the state of Haryana. This is lower down, so not many large farmers. In the initial year, we did 2,600 accounts. We opened 500 BCs. By year 3, all 2,600 accounts are active, and we have an average savings account balance or checking account balance of 15,000 rupees, which is equivalent to an urban customer. And 25% of these have already been converted to agricultural loan. So that's a key success story. This slide should have been a little earlier. If we had to grow without supply chain in the other states, the faster we want to grow, the higher the drag on our profitability, which is the blue line. And if we grow through open market, you can see the red line going all the way up. But this has thrown up another challenge because we are able to move up on the supply chain so fast. In dairy, we grew 300% on the supply chain, sugar 400%, seed production 800%. The problem now is how fast can we convert these into loans, right? So we are right now with this challenge of redefining our process, redefining our credit process, our operations process, automating a lot of the workflows and using imaging technology to speed up the loan conversion. Just to give you a comparison, from 2007 to now, we disbursed about 70 loans to 70,000 farmers. And under supply chain, in between October to March, we have got 100,000 farmers ready for loans. So it's a problem of plenty that we need to address. Key challenges that remain are cross-functional internal challenges because it's all new to the bank, new processes, everything is new, and it takes a hell of a lot of effort. It's easier to handle the market. Selecting the right corporates to get the accounts active remains a key challenge, but there's a lot of good news on that side. Things are changing pretty fast. BCs, yes, will remain a challenge. We have to automate. We have experimented with some automation. BCs, the problems with BCs is viability, because if the accounts don't get activated, they don't see transactions, they don't see money. So and each company buying one crop, they have to wait for the next crop cycle before they see the money, and they lose interest. You have to ensure service quality and bring in as much technology as you can. And liquidity management, cash being the biggest challenge over here. We are, though, experimenting with POS machines at fertilizer stores and merchants to create a cashless environment in the village. So here's an example of what we did with the BC and how we can automate it in the dairy supply chain. What this essentially does is it connects, there's a device that connects the weighing machine and the fat testing machine to a small device that has a transmission capability, and it's formatted to standard bank protocols and messaging types. This has the capability of sending the message straight into the bank switch and converting it into an account entry instantaneously. Now it's up to the company if they want to do it instantaneously or do it in batch mode. But what it does ensure is absolute transparency in milk collection, quality and fat. It ensures transparency in the payment. There's also a cash dispenser attached to it, so the farmer can withdraw his money. If it's instant, he can withdraw it there and then. If the milk collection center or the milk company, if it's a cooperative or a company and they want to do it on a batch mode, it can facilitate a batch mode. So this is one of the methods of how we're trying to use technology to reduce or improve the services at a BC, or mistake-proof services at a BC. This can be taken forward, and what we will intend to do is look at maximizing our businesses in the villages that we want to work on a different level. So the same device can be used for recording information on vegetables and grain. If it's a cooperative, for instance, if it's a cooperative, the cooperative today already has a milk chiller. There is a device being tested which is 100 square foot micro cold storage with a multinational company. If that comes in, that can be attached, and standard practice of a warehouse or a silo bag, where this information through the same device that does the milk testing can go into a data center. Data of the produce can go into to the company data, and they can quote their prices and buy the process. Settlement done through the bank account, and there's a local ATM or POS through which money can be withdrawn. So this is what we want to graduate to. It's a bit of a dream, but yes, we are working towards it. So this is about HDFC Bank. It's in your folder. You can go through it. We've done pretty well so far, and the future of the bank's growth is going to come from the rural markets, and that's a strong commitment from the management. Thank you.